Welcome to the Shipper Update. I'm Anthony Smith, lead economist here at FreightWaves, and I'm here with the one and only Donnie Gilbert. So, Donnie, we're going to dive into an area that I love getting into, and that's manufacturing, and that's all things upstream. In particular, we're going to look at, of course, our flatbed outbound tender rejection index in the green line, and in line with it, I also have the ISM PMI, which just got refreshed just last week. And so, looking at it, when you look at the blue line, the ISM PMI, it's going to be reflected, or it's going to be based around the number 50. So anything above 50 is going to be indicative of expansion within manufacturing, while anything below 50 is indicative of contraction in manufacturing. Now, of course, you all know this green line here, the flatbed outbound tender rejection index, which is going to really show, Donnie, the capacity or the tightness in capacity for flatbed trailer types. And so we're seeing that it's right at 23%, saying that roughly 23% of all flatbed tendered loads are being rejected. So that's relatively high for flatbed, is that right?
Yeah, so here you can see this is the highest it's been in, over a year.
Yeah.
So it's kind of, flatbeds took the hardest hit when it came to the COVID pandemic. And we really saw, that drop off. There's people staying at home, road construction, everything slowed down. And that, as you can talk about economically, this sector is the hardest to recover. So, and since flatbed moves a lot of this, it's going to have a big input on what's going on with flatbed. But here, what's interesting is we see flatbeds have picked up to the 23%, and we're heading into their slow time, but they're still kind of holding strong.
That's exactly right. They're staying high, and one of the big things that we're seeing right now is within manufacturing upstream. So within that ISM PMI, as I mentioned, anything above 50 is indicative of expansion. We're seeing a reading of 61.1 percentage points, and so that is an increase of 1.1 percentage points in this latest report. New orders held steady, staying at 66.7 percentage points, and so those are both 16 months of this continuous trend of expansion within both production for the overall PMI and new orders. Looking at production overall, because that gets broken down as well, we're seeing that number right at 59.4, so a slight, just less than a percent decline, so nothing too overt or too crazy there. In our next chart, the area that I was going to be looking at closely in this report is going to be around prices. And what we see in prices is pretty incredible. We see a reading of 81.2, and so that is showing that there is indeed continuing increasing pricing pressure. So, Donnie, this is something across the board. We're just talking in the carrier update about how used truck prices are elevated. We're seeing these commodity prices for manufacturing goods still elevated. So these purchasing managers are seeing increased pricing pressures, even if we start to see this downward movement here that we saw from over 90 down into the low or to the high 80s. That's still expansion. It's just expanding at a slower rate. So seeing this maintain this high level is incredible.
And this makes sense because, roughly July is the peak of the summer shipping season, the peak of the vacation season, and the peak of produce season. And then, of course, things slow down between July and normally through about the end of September is kind of that calm before the storm, I call it, as everything kind of slows down, getting back to school and here before the fourth quarter starts. So this makes a lot of sense. So does this adjust for inflation? Is inflation included in this?
So this is going to have inflation, I think, baked into it. So essentially what we could see is that this pricing pressure continues to increase even if we start to see slowing down in production or new orders coming in. So it could be that there's more money used for buying less stuff just because it's priced so high. But the incredible thing that we're seeing right now is that new orders aren't really slowing down all that much. We're still seeing production come in. And so despite these pricing pressures going up and up and up and staying high and elevated, manufacturing isn't slowing down because of pricing, but it is easing in terms of available commodities and employment.
And then keep in mind, we can't get goods into the U.S. right now. The ports are too congested, the rail's too congested. So that supply and demand will work itself out.
Yeah.
The supply is very tight, or the demand's very high, the supply is very tight, so that's going to push rates up even more. So your brand new television that was $399 last year at Walmart might be $699, $799.
Yeah.
So again, it could be like exactly what you said, fewer goods, higher prices is what we're going to see probably over the next 3-4 months at least.
Exactly. And great point there, because in our next chart, what we're going to probably get into a little bit later on, is going to look at customers' inventories. And so this is going to be an inverse in effect. So remember, we're talking about anything above 50 indicative of expansion, anything below 50 contraction. This is at 31.7. So this is showing that there is a significant contraction for customer inventories, and it's showing that these inventories are way too low. So Donnie, spot on in that phrasing and talking about how there is this tightness in supply. We're seeing it here on this ISM PMI customer inventories chart here, because this is now at a 31.7, significant downward movement in customer inventory levels.
And this is something, when it flips to the carrier side, as we go to, when things finally get caught up and go to replenish this, it's going to be trucks.
Exactly. Donnie, thanks so much for joining me for this segment.